Massmart is next. Now, this one was built up from the South African branch of a Dutch retailer called Makro, which disinvested, then Wooltrue got involved. Trades in this country as Makro, of course, and then as well Game, Dion Wired, Builders Warehouse, Cambridge, and a thing called CBW, which you'll know if you come from the rural areas. It's 51% held by Wal-Mart, the largest retailer in the universe. It's got a market cap of 40.3 billion rand, dividend yield of 2.5%, price to earnings ratio 28.3. Daniel, I mean, this has been a very interesting story because, of course, that's the announcement of the Wal-Mart buyout. 140 took forever to close. Since the deal, though, its earnings have been rather poor, considering that they had all these costs associated with the transaction.
Yes.
But clearly, this is one that global fund managers love because they like the idea that, you know, Bentonville owns half of them, so who cares who owns the other half?
I think that's exactly right. I mean, now the guys are in there, the international fund managers, they know the Wal-Mart name, they like the African exposure story, so they're happy to hold. Irrespective of the valuation, and I think this is one where the guys are firmly in and there's nothing that's going to get them.
I wonder if they even bother to read the results. They probably say, what's this cute currency, rands? I wonder what that's all about. I mean, they just basically say, Africa, Wal-Mart, retail, let's go. But in terms of the local marginal market, I mean, it has held its level pretty well at around 180, there around.
Yes.
I mean, the danger, of course, is that, I mean, like we were saying with Pick n Pay, it could take forever for earnings to kind of normalize, and we expect big capex expenditure as they try to beef up their exposure northwards of the border. So, I mean, earnings could be pretty diminished for a while here.
So I think the main difference I'd say to Pick n Pay is that the problems they're not business efficiency structural problems, it's more just integration problems, which are very different. You know, there's nothing intrinsically wrong with the business. They just sort of have to put all the systems together and make it go as one unit. They do, in the results, they do actually strip out the costs from that whole process.
Yeah.
So those earnings are obviously quite a bit higher than the reported earnings. And one interesting thing they did mention at the most recent results is that they believe the margin compression has come to an end, meaning that the expenses growing faster than the top line, that has slowed down or come to an end. So you are going to see margins stabilize from here on out, and I think that was quite a positive statement.
The other thing about this one to note is that there are lots of different businesses in there. So, you know, Builders Warehouse targets the middle classes, and that's sort of like a knockoff of Home Depot. Dion Wired is like Best Buy, which in this country still has a future because people have to buy scratch screen TVs and Amazon doesn't exist. And then there's, you know, Cambridge, which is a massive expansion into that sort of limited lines, low-cost kind of retail market in high transit areas like taxi ranks. Each of those businesses could ultimately, you know, be much larger in its own right. So anyway, I got nothing more to say about this one. We've held it since, you know, 30 Rand a share roughly in our client base. We were very happy with the buyout. We used the proceeds of the buyers to buy them back. So it's kind of been one we've been in for ages. What's your feeling, though, at the current share price? Are you happy with it? Hot, not hot?
So my feeling is that it's expensive. I've thought it was expensive for a long time, so we haven't owned it, and we've missed out, obviously, from the price graph. But I'm happy to stick to valuations, and my valuations tell me it's still expensive.
Still expensive, so not hot. Okay,
Not
well,
hot.
I'm in the family, so I've got to say it's hot.